Welcome to the Deep Dive, where we cut through the noise of earnings season to bring you the real story behind the numbers.
That's right.
Today, we're dissecting AMETEK's second quarter 2025 results. And this wasn't just another earnings call, was it?
No, definitely not. It felt more like, well, a masterclass in how a diversified industrial company can navigate, maybe even thrive in this uncertain economic landscape.
Absolutely. The market certainly seemed to agree. We saw that immediate positive reaction.
We did.
So we're here to unpack exactly what.
Indeed. What we saw was a company delivering, strong performance despite the headwinds, and they provided an optimistic outlook, which, like you said, the market clearly appreciated.
So we'll explore the key financial beats that caught investor attention.
Yep, the strategic moves setting them up for the future.
And those management insights that really drove the positive sentiment.
Exactly.
Okay, let's unpack this. Quick look at the headline numbers first.
Let's do it.
AMETEK reported GAAP EPS. That's generally accepted accounting principles, earnings per share of $1.55.
Right, which comfortably beat the $1.50 consensus estimate.
By 3%.
Yeah.
And their adjusted EPS, that came in even stronger.
A robust $1.78.
Surpassing the $1.69 consensus by, what, 5%?
A solid 5% margin beat there, yeah.
Pretty impressive. And the revenue story.
Equally impressive, really. They hit $1.78 billion against a $1.73 billion consensus.
Okay, so that's nearly a 3% beat.
And 2.5% growth year over year. But what's really significant, I think, is the operational efficiency.
How so?
Well, operating margins expanded by 20 basis points.
20 basis points, so 0.2%.
Exactly, up to 26%. And that drove operating income up 3% to $462 million.
Okay.
But maybe the standout figure for me, honestly, was their free cash flow.
Oh, yeah.
$330 million. And the cash conversion rate, it exceeded net income, a remarkable 102%.
Wow, 102% free cash flow conversion. That is fascinating. Maybe unpack that for our listeners.
Yeah.
Why is hitting over 100% so strong, especially for an industrial?
Yeah, that's a great point. It basically means AMETEK isn't just profitable on paper, right? They're turning pretty much every dollar of reported earnings into actual spendable cash.
Which isn't always the case.
Not at all. Lots of companies report strong earnings, but then struggle to convert it. High capital spending, inventory piling up, customers paying late.
Got it.
So AMETEK showing over 100% conversion, that signals incredibly efficient operations, really robust working capital management.
And gives them flexibility.
Immense financial flexibility, yeah, for M&A, R&D, without needing tons of debt.
Right. And the CEO, Dave Zapico, he kind of captured this perfectly, didn't he?
He did.
Highlighting record sales and EBITDA, strong earnings growth, and excellent core margin expansion against a sluggish and uncertain economic environment.
That's a powerful statement right out of the gate. It suggests they're not just, surviving, they're executing.
Definitely executing. Okay, so beyond those top-line beats, the real story is often underneath, right, in the driver. Let's peel back the layers. Total sales up 2.5%. We got that. But organic sales?
Flat for the quarter.
Flat. So excluding acquisitions, currency fluctuations, no growth there from existing businesses.
Right. Acquisitions added 1.5 percentage points of growth.
Okay.
And foreign currency translation gave them another 1-point tailwind.
And they ended the quarter with a book-to-bill of 1.00.
Exactly, 1.0. And a near record backlog, $3.47 billion.
Okay, so orders matching shipments, backlog still strong.
But what's particularly fascinating, going back to that flat organic number, is seeing it alongside that impressive core margin expansion.
Right. You mentioned the margins.
Yeah. If you exclude the dilutive impact from acquisitions and foreign currency, core margins were very strong, 26.7%.
Up 90 basis points year over year.
90 basis points. That really highlights AMETEK's successful pivot, towards being a high-margin software-enabled platform.
So they're getting more profitable from the business they already have.
Exactly. Which makes their record EBITDA $565 million, margin of 31.8%, even more impactful. That operational discipline is just crucial.
So even if organic sales were flat, they're clearly doing a fantastic job wringing more profit out of every dollar.
Absolutely.
But speaking of strategic moves, this is where it gets really interesting.
The M&A.
Subsequent to the quarter end, AMETEK completed its $920 million cash takeover of FARO Technologies.
Yep, the 3D metrology firm.
Being integrated into their ultra-precision technologies division.
This FARO acquisition is significant. And it's a great example of AMETEK's M&A playbook in action.
How so?
Well, FARO brings about $340 million in annual sales, and it nicely complements what AMETEK already does in metrology and precision imaging.
Especially within their Creaform business, right?
Exactly, within Creaform. And management anticipates substantial operating margin expansion for FARO.
They have target.
They do, targeting 30% EBITDA margins in about 3 years.
30%, wow. Up from FARO's current 15%.
15%, yeah. Plus, they expect mid-teens cost synergies.
And it should add a bit to earnings next year.
Expected to add a couple of pennies to 2025 adjusted EPS.
Okay, that 30% EBITDA margin target for FARO from 15% today in just 3 years.
Yeah.
That feels ambitious.
It does sound ambitious.
What gives management confidence they can actually achieve that? What are the hurdles?
Well, it's interesting they actually drew an analogy to their ZYGO acquisition. Highly successful, over a decade ago.
Oh, okay.
ZYGO saw sales grow at, I think, a 9% compound annual growth rate, here we are, and EBITDA. It increased fivefold under AMETEK's ownership.
Fivefold. Okay, so they have a track record.
It suggests they have a proven model, for integrating and optimizing these kinds of businesses, especially in precision tech.
Hurdles still exist, though, surely.
Oh, definitely. Cultural integration, seamless tech transfer, those are always challenges. But their history suggests they have pretty robust processes.
And FARO fits the strategy.
Perfectly. Adds a strong recurring revenue piece through service and cloud subscriptions. Aligns exactly with AMETEK's strategic shift.
Got it. And beyond acquisitions, innovation seems key too. Record R&D spending.
Record R&D outlays, yeah. They even teased some next-gen power measurement platforms.
Right, for launch at Electronica in November. Pairing ruggedized sensors with edge analytics. Sounds very AMETEK.
It does. And their vitality index, measuring new product sales, stood at 26% in the quarter.
26%. Is that a good number for an industrial company's vitality index?
Yeah, for a company like AMETEK, 26% is pretty robust. It means over a quarter of their sales are from recently introduced products.
Which indicates a healthy innovation pipeline.
Exactly. Strong ability to turn R&D into actual sales, fresh revenue, not just relying on old stuff.
Okay. This brings up a big question, though. How are they navigating the wider macro environment, especially things like trade uncertainties?
Yeah, management talked about that. They outlined proactive, multifaceted tariff mitigation plans, things like targeted pricing initiatives, supply chain adjustments, and really leveraging their global footprint to localize production where needed.
Did it work?
Seems so. They indicated that the previously flagged $100 million negative tariff headwind for the year is effectively no longer a headwind.
Wow. Okay, so they basically neutralized it.
That's what it sounds like. This proactive operational excellence, supply chain resilience, it's clearly driving results, minimizing those external shocks.
And looking ahead, they seem confident. They actually raised full-year guidance.
They did. Full-year 2025 adjusted EPS guidance, now $7.06 to $7.20.
Up from $7 in 2000 to $7.18 previously.
Yep. And they expect mid-single-digit sales growth for the full year. Q3 EPS between $1.72 and $1.76. Confident outlook, like you said.
Definitely.
And furthermore, there's that newly enacted tax reconciliation bill.
Ah, right. What's the impact there?
Well, provisions for immediate expensing of R&D and capital equipment that should favorably impact their cash tax position.
Okay, good for them.
But importantly, it's also likely to spur customer capital investments, particularly in the U.S.
Ah, so potential tailwind for AMETEK sales too.
Could be, yeah, as their customers look to take advantage of those new tax benefits.
Okay, interesting. So what does this all mean when we break it down by their different segments? The Electronic Instruments Group, EIG.
EIG delivered solid operating performance. Sales up 1% overall.
Okay, but organic sales were down 3% there.
Down 3% organically, yeah. But operating margins held up well, 29.7%, and core margins were very strong at 30.7%.
Still strong profitability. What about the other side? Electromechanical Group, EMG.
EMG had an excellent quarter, really stood out. Sales up 6%.
And organic.
Organic sales up 5%. They saw record operating income and substantial margin expansion.
How much expansion?
Up 210 basis points to 23.3% overall. Core margins up an impressive 260 basis points.
Wow, 260 basis points. What drove that?
Strength in their Paragon and automation businesses was key, and significantly, Paragon's EBITDA margins are now aligning with AMETEK's overall margins.
That's a great sign of successful integration within EMG.
Absolutely. Shows they're getting that optimization right.
So it's interesting that divergence in organic growth between EIG and EMG. What about the end markets?
It's right. Looking at end markets. Aerospace and defense, very strong results. High single-digit organic sales growth.
Leading to a raised outlook there.
Yep, raised full-year outlook for A&D. Power businesses saw low single-digit organic growth, positioned well for grid modernization efforts.
Good.
Their automation and engineered solutions actually returned to growth.
Good sign.
And the company confirmed that those destocking issues, the ones that hit medical technology and automation.
Yeah, we heard about those last year.
They confirmed those are largely over now.
That's a relief for them, I bet.
Definitely helps. So if you connect this to the bigger picture,
Yeah.
Yes, some areas like process businesses saw flat organic sales.
Why was that?
Trade uncertainty causing some hesitation in project spending, apparently. And the semiconductor and research academia markets faced headwinds, too.
Right.
But the company's diversification, those proactive mitigation plans we talked about, they allowed them to maintain strong overall performance despite those pockets of weakness.
And the balance sheet. Still healthy after the FARO deal.
Still quite healthy. Gross debt to EBITDA remains low at 0.85. It increases modestly to 1.25 pro forma for FARO.
So still very manageable.
Very. Leaves them with over $2 billion in cash and credit facilities and capacity to deploy maybe $4.5 to $5 billion more if they chose to lever up to 2.5 times.
Wow, significant M&A firepower still available.
Huge firepower. It really underscores their strategic story, Evolving from just a hardware supplier to this high-margin, software-enabled instrumentation platform backed by a big M&A war chest.
Okay. Now, it wouldn't be the deep dive without taking all this insight and, purely for intellectual sport.
Definitely not financial advice.
Absolutely not. But trying to cook up a bold yet plausible investment thesis. Think of it as our high-stakes fantasy league for industrial stocks.
All right, I like it. So given AMETEK's solid Q2, that robust guidance, the clear M&A playbook, the trade idea here is maybe a relative value play.
Okay.
We're pitching a long AMETEK Emeterio short industrial select sector SPDR fund XLI pairing.
Long AME, short XLA.
Yeah.
So betting on AMETEK's outperformance against the broader industrial sector, that's a strong call, especially with the macro backdrop being, sluggish.
It is.
What makes AMETEK the compelling bet versus its peers like EMR or MTD right now? Global PMIs are hovering near 50. CapEx is still selective.
Precisely. While the broader industrial landscape faces those headwinds, AMETEK just keeps executing. They continue to acquire strategically, expand margins through that relentless operational excellence.
And their peers lagged on earnings day.
Yeah, peers like EMR and MTD actually lagged on the day AMETEK reported. It sort of underscores AME's relative strength in the market size right now. The FARO acquisition, that proven ZYGO integration track record, the stated capacity to deploy billions more in M&A. It effectively makes AMETEK a compounding machine, in an otherwise sluggish industrial backdrop.
So they're not just growing organically.
They're buying growth, and critically, they're optimizing it post-acquisition to really juice those margins.
Okay, so the thesis really boils down to this. AMETEK's aggressive yet disciplined M&A strategy, combined with their proven ability to extract synergies and expand margins, will let them outperform the broader industrial sector, even if the macro stays challenging.
That's the core idea. It's a conviction play on management's ability to execute that transformation.
Got it. Okay, let's recap then. AMETEK delivered a really strong second quarter.
Yep. Beat expectations on key metrics.
Raised full-year guidance. Showed impressive operational resilience in what's still a tricky economic climate.
Definitely. And that FARO acquisition really stands out. Big strategic move.
Promises substantial margin expansion, further solidifies their spot in high-growth niches like 3D metrology.
And the company's ability to just navigate those trade uncertainties proactively, combine that with the healthy balance sheet, the robust M&A pipeline, it really positions them firmly for continued long-term growth.
Clearly executing on that transformation.
To a high-margin, software-enabled instrumentation platform, yes.
So as AMETEK continues down this path, transforming from hardware supplier to this high-margin software-enabled platform through shrewd M&A and that relentless operational discipline, it kind of begs a question, doesn't it?
What's that?
Are they just showcasing best-in-class execution for industrials? Or are they maybe inadvertently providing a new playbook for the whole sector? on how to not just survive, but actually thrive in this era of constant economic flux. Something to think about.
Interesting thought. And just that final reminder, of course, this deep dive is for informational purposes only.
Definitely not financial advice.
Not financial advice.
That's all for this deep dive into AMETEK's earnings call. We hope this gave you the clarity and insight you needed to understand their recent performance and strategy.
Yeah, I hope it was helpful.
We love hearing your thoughts, so feel free to reach out. Until next time, stay well informed.